Hi, everyone. My name is Matt Brown, and welcome to the Direct Private Investment Show. With me on the line is CEO of Carofin, Bruce Roberts. Welcome to the show.
Right. Thanks, Matt.
So, Bruce, time is something that we value most, but what we use worst. How do you prioritize what deals you should be focusing on versus those that you don't? Because having spoken to you now at some length, I know that you evaluate hundreds, if not thousands, of deals in any given period of time. So you need to choose which ones to focus on and which ones to say, we're going to pass.
Right.
So how do you resolve that problem?
Well, there's kind of two steps to this. First of all, I should say we're like many financiers of venture stage businesses. We have a network of individuals who have industry expertise that they're investors, but they're also information sources for us to and sources of deals, right? So we get most of our deals through referral, and that is not in and of itself say we should jump on every deal. We still have to review the deals ourselves. Years ago, I was asked to evaluate a nanotechnology company that was looking to move to Asheville, North Carolina, and actually I was asked to participate in a meeting with the principal, really to pitch Asheville, Western North Carolina as a place for that company to move. And I think I spent 2.5 hours with the individual, and 2.5 hours later, I really didn't even know what they did. And I have a sense of what nanotechnology is, but this individual couldn't communicate what their business was about. And frankly, I came away upset with myself after that dinner because I'd burnt 2.5 hours for who knows why. And that was the motivation to create a system where I could basically run through the issues that would let me begin to get a sense of where is a business, in the scheme of things. Now it's not an end all, it's just a start. But typically in 30 minutes or less, I can go through 7 questions with a company and I'll have a pretty good sense of where they land. And no company is perfect, but you get a relative sense of, is this one I want to spend some more time on or not? So that's how I did it.
So 7 questions is all that you need as an investment banker to understand whether or not to focus on this deal. So it's
a good start.
It's a good start.
It's a framework that I would argue covers ground that often what tends to happen with a company when you're first introduced to it is you're kind of mesmerized by something shiny and sparkly, right? It could be the effervescent personality of the entrepreneur, someone like yourself. It could be monster market opportunity, who knows what it is. But at the end of the day, does it make sense as a business, and does it, of course, make sense as an investment? So
let's tackle these 7 questions. What's the first question on this list?
These are all going to seem really basic, but it is relatively comprehensive. The first question is, what do you do? You would be shocked how many folks can't succinctly tell you what they do. And the deeper you get into technology, obviously, the more rarefied air it is. but I would argue, at least for the kind of deals that we do, I need to know what they do pretty clearly. They need to know what they do pretty clearly, because if you can't communicate what the business is about succinctly, you probably won't be allocating scarce resources efficiently. Can you stay focused within what's most important to the business? So the first one's pretty simple. What do you do?
And it's amazing. I agree with you how in many cases, a business owner battles to really articulate that in a way that's simple for somebody to understand.
Well, think about it. They're trying to attract customers. And if you can't, clearly state what you do to anyone, are you able to do that to your customer, right? And so your prospective customer, in the case of a venture deal.
What's number 2?
Number 2 is, who are you? Who are you is basically, who are you and why you? I mean, I should say we do personal background checks on anybody that we would finance, criminal and otherwise. But we're really talking about industry expertise. We're talking about existing track record, say, for venture finance. We could be talking, is this your first rodeo basically in the venture world? Because, the classic challenge is you get someone who's very accomplished in a big company world. They've risen through the ranks. They're running a large part of that company, And for whatever reason now, by the time we encounter them, they want to do a startup. Different deal altogether. You don't have the support network. Again, you can be a very good manager in a corporate setting and just not be suited for the rough and tumble of, the early stage company world. So who are you?
Gotcha. Number 3?
Number 3 is where are you? And where is not geographically. I do care if it's offshore. We tend to do domestic work, and doing an offshore deal is kind of expensive. But where are you is really what stage is your business. And one person's pre-IPO is another person's startup, right? And so it is kind of amazing, someone who's got basically a concept, a gleam in the eye, thinks they're one step away from going public. And, for me, it's pretty basic stuff like, well, the classic is, do you have a product yet? Do you have something you can deliver in the hands of a customer? Has someone actually agreed to pay you for that product? That's a pretty big chasm to jump over. Are you generating operating cash flow, for example? So, yeah, where are you? And, that has a real sense of, okay, what type of investment are we really looking at here? Is it a venture stage equity investment? Or are we looking at, raising short-term working capital that's going to pay the investor a current return every month?
So number 4 is about the customer.
That's right. This is a real hot button for me because most venture stage businesses fail, in my experience, not because they can't produce the product, but because they can't attract sufficient number of customers and make a business of it, right? Entrepreneurs tend to be focused on the product side of the business, and they don't put adequate weight to the customer side. And so when I start talking about who's your customer, it's very enlightening, because where I want to go to is I want to get in the head of the customer, or you to take me into the head of the customer, if you're a prospective issuer, and know, how is that purchasing decision made? Is it an individual? What's the profile of that individual? Are they, do they work for the government? There has some whole connotation of the approval process. Is it a decision by committee? What's the politics they're dealing with? I would say, as a general rule, in my experience, little plays well with little. Little doesn't play well with big. So it's quite common to have someone show up with a business plan that, they're quite sure, Fortune 500 company is going to jump into this and is going to somehow commit a critical part of their business to buying their startup, product and concept. It doesn't happen. At least, it's catching lightning in a bottle if it does. It's really, what I want to see is a like match of a customer, retail or business to business, that has a scale and is is incented to buy the product from a company that is a fragile venture stage business. And I'd say one other thing on the customer side: motivation for purchases tend to fall in one of 2 buckets. It's either value driven. If I buy your new thing, I save time, I save money, it's more attractive. Or it's fear driven. There's some urgency to what you're producing. And, the probably more classic example would be coming out of COVID. While these weren't startup businesses, everybody was scrambling to find a vaccine to deal with COVID. And if you had something that was reasonably compelling, you were going to cut through a lot of the normal checks and balances and just process that, people couldn't afford to sit on their hands, right? So you're looking for urgency.
Yeah. It's really interesting, that point around how people respond to the carrot and the stick, or the regulation versus the future value of the opportunity. It's very important to know that. Customer.
It's got to have adequate weighting. You've got to really push deep into, because again, from 27 years later, venture companies most usually fail because they just haven't fully thought through the mechanism, the purchasing process, the customer adoption cycle, the cost of making the purchase. It's the biggest challenge I know of in business, consistently.
So let's talk about product, or, the role of product in this framework.
Well, that could get you to question number 5, actually, which is, how do you do what you do? And that is going to be radically different based on the stage of the company, based on the nature of the product. Is it a product or is it a service? I've had quite experienced investors share with me, actually people who've been in different types of companies. They've run service businesses and they've run manufacturing businesses. And the general rule of thumb they give me is that a manufacturing business is 5 times harder than a service business. And I think the reason for that is often there's a dependency on third parties in your supply chain to do what they're asked to do within the spec you're asking to do when you're asking them to do it. So you become, by definition, dependent on third parties. The other issues, as we've talked about earlier, regulation. There again, there's a whole, to the extent you've got a product that's dependent upon some regulatory approval process or licensing process. Well, let's just say with 100% consistency, I've yet to find something that's dependent upon a government entity to do something as presented in a rational manner in the time that it's been presented in that time, if at all. It's consistently been a disappointment. And I think the reason, quite classically, is the entrepreneur has an urgency to get through this. And so they're thinking this is a done deal because it's so clear the value. The counterparty that's providing that approval is on a whole different schedule with a whole different, when you're dependent upon third parties, you never really know what else is pulling at them for their time or their resources. So how do you do what you do? Question number 5 is a pretty critical one.
Number 6, about the business model.
Yeah. Well, this may seem like it should be the first question, but you would be shocked how often in a venture conversation, everyone's so enamored with what, the deliverable is that they kind of don't get around to, well, how do you make money, right? Different products have different inherent margins associated with them. I often take sweet potatoes. Because we're from North Carolina and because North Carolina's a big sweet potato producer, we happen to have financed a lot of sweet potato activity over the year. And so if you're growing sweet potatoes and packing sweet potatoes, you're talking about a company whose inherent gross margin is somewhere in a 5 to 10% range, right? Gross margin being revenue less cost of goods sold. And because sweet potatoes, they come out of the ground, then they get packers take them, they have to be cleaned up and get sorted and ready for delivery, and they're stored for a while. So that's a pretty thin margin business, much like a grocery store is a thin margin business. If you take that sweet potato and you turn it into a French fry, okay, now you're up the value chain, right? That business ought to be about a 35% gross margin, right? And we've done sweet potato French fry plant, and it had all the challenges I mentioned earlier in terms of manufacturing. I mean, you've got a production line, you've got belts that got to be replaced, literally a lot of moving parts, that everything has to happen at the right time and the right way to get the end use product. If you take that same sweet potato and you turn it into vodka, which happens now, well, that ought to be about a 90% gross margin business. Again, gross revenue less cost of goods sold. And that certainly we finance other distilled, alcohol, bourbon, what have you. But they're going to give that money back in the form of marketing and just, what it costs to cultivate the consumer. But, my point is, when you ask the entrepreneur, how do you make money? The first thing it tells you is, do they even speak in financial terms? And you would be shocked how many folks would say, well, I don't do that. I leave that to my CFO. By the way, young companies don't really need or have CFOs. They need controllers, but that's another story. Controllers manage cash in the current. CFOs look over the horizon. Accountants, by the way, look backwards. They prepare your tax returns, and that's all necessary. But for the rough and tumble of running a business in the current, we tend to look for financial management at a controller level more than anything else. But the point is, if that entrepreneur doesn't speak comfortably about gross margin inherent to their product, if they're not talking about when do I generate operating cash flow, things of that nature, well, that's a red flag. I would argue the chances of you making it to a liquidity event and someone being financially blind about the condition of their business, you don't want to go there. And so that's just a hot button for me. And that's both what's the inherent margin of my product, and then how well is my business performing in the real time, and what financial systems do I have? So anyway, how do you make money?
Which is important for investors, which is the next question, right?
Well, that gets you to number 7, which is how you going to pay me back. and that's you're looking for a different answer for different types of investments. if you're providing working capital through private lending, or let's just say you're helping finance an acquisition of some asset or whatever, it's a fixed income security with a set repayment schedule, monthly. We structure ours with monthly payment because if something's coming off the rails, I want to know in 30 days, not in 90 days, right? So we tend to go to a 30-day payment schedule, but there has to be operating cash flow to meet that debt service, right? And so I'm going to get liquidity on a debt instrument either through some amortization, which is a continual payment over time, and a fully amortizing note would be one that's fully repaid at maturity, or I'm going to get paid through something that often is a projected payment of principal at maturity. Now, begs the question, where does that money come from to meet that redemption? You want to see it coming out of operating cash flow. And frankly, I tend to do amortizing transactions, so I'm reducing the principal exposure over time, as opposed to having this final maturity bullet payment, we call it, that may be there or may not. And if it's not, then everybody's scrambling to figure out how do we get it? Do we liquidate collateral? Do we refinance? Equity, on the other hand, of course, is very different. If it's a venture stage deal, I would beware of the projected IPO. IPOs come and go. It takes a pretty large offering to do an IPO. I think on the street, at least $200 million of proceeds, which kind of suggests you're going to get something approaching $1 billion market capitalization to make it happen. And if you're financing an early stage company, it begs the question, can this really be $1 billion company, and what has to happen to make it so? Yes, there are unicorns, but I wouldn't limit yourself to looking at those. I think the more common path would be, selling the business. In certain industries, beauty would be a good example, are highly acquisitive. So your L'Oreal's and your Lancome's and the major beauty companies, they scale by buying smaller companies that can enhance their product offering. They're buying a company that might be at 20 to 50 million in revenue, and they can scale it to billions in revenue simply by putting it in their manufacturing and distribution chain. So that's an efficiency for them. And for you as an investor, then, you got in early, you took the risk that it was going to become that $20 million plus business. But, the one thing I think, we all tend to, I tend to shy of entrepreneurs that are, what I'm hearing is world domination when they present their business model. There's a few, Bill Gates, Steve Jobs, God rest him, Elon Musk. There have been people certainly who've done amazing things as entrepreneurs. That's what we read about in the media. You don't have to, if you latch on to one of those, good for you. But man, you can have a great portfolio by doing much more modest deals, because what I care about is what's the rate of return that my investors are getting. And I would say for the audience here, whether you put $100,000 in or somebody could put much more, what you care about is what's the return on your investment. And you could be far short of world domination and still be quite happy with the investment performance. So those 7 questions, and I'll quickly repeat them because they're pretty simple. What do you do? Who are you? Where are you? Who's your customer? How do you do what you do? How do you make money? And how are you going to pay me back? You go through a conversation with those 7 questions with someone, it's incredibly enlightening. And you've covered, it's a pretty comprehensive conversation at that point. Then you begin to go through, you've got a whole path in front of you, which I would say quickly would go to, well, what is the security you're offering me, right? And does everything you've told me make sense? For example, you're a venture stage business that wants to issue, a 18-month note that's going to pay interest monthly. Well, no, you don't have the cash flow to do it, right? The second thing that begins to prepare you for are looking at, okay, they told you what's going to go right. Well, let's look at what can go wrong. What kind of challenges will this company face? And then you want to break that into 2 buckets. What product challenges related are there, and what sales challenges related are there? Then when you've got all that, then I would argue you're in a position to really, if you really want to hunker down, you start getting into a deeper due diligence. And so you're gathering data. You now know where to prioritize your diligence efforts, and you can really zero in on market size, whatever the case may be. So there you go.
Thank you so much for that, Bruce. And I think the key thing for investors is this process really helps you present the best types of investment opportunities to the investor community.
it's a good starting point for the deals that we consider deeply. Yeah, we believe we've gone in with a comprehensive view.
Perfect. Grace, thank you.
Matt, thank you.
Cheers.